Listen, I don't care if you think you've got it all figured out. I don't care if your financial advisor told you diversification is enough. I don't care about your feelings or your ego. What I care about is your money. And right now, if you're relying on traditional investment strategies to protect you during a market crash, you're about to learn one of the most brutal lessons in finance. You're not prepared. You think you are, but you're not. Here's the truth that nobody wants to tell you. When the market crashes, and it will crash again, it's not a question of if, it's a question of when. 95% of investors get absolutely destroyed. Their portfolios evaporate. Their retirement dreams disappear. Their financial security vanishes overnight. And you want to know why? Because they're following the same outdated, broken strategies that everyone else is following. They're doing what poor people do. They're making emotional decisions based on fear and panic instead of logic and preparation. I've been investing for over 40 years. I've lived through multiple crashes. I've watched fortunes built over decades disappear in weeks. I've seen supposedly smart people make catastrophically stupid decisions when the market turns red. And I've also seen a small group of wealthy, disciplined investors not just survive these crashes, but actually profit from them. That's the difference between rich people and poor people. Rich people prepare for crashes. Poor people hope they won't happen. What I'm about to share with you is the only investment strategy that consistently survives market crashes. Not sometimes, not occasionally, every single time. This isn't theory. This isn't wishful thinking. This is proven, battle-tested reality. And if you ignore it, you're going to pay a massive price when the next crash comes. But first, I need you to do something. If you're serious about protecting your wealth, if you're tired of watching your portfolio swing wildly with every market hiccup, if you want to build real financial security instead of gambling your future on hope, then hit that subscribe button right now. Join this community. We're building something here, a group of people who understand that successful investing isn't about getting lucky in bull markets. It's about surviving bear markets. Subscribe now because what I'm sharing today could be the difference between retiring comfortably and working until you're 75. The strategy I'm talking about is simple, brutally simple. So simple that most people dismiss it because they think investing has to be complicated to be effective. It doesn't. In fact, the more complicated your strategy, the more likely it is to fail when things get ugly. The strategy is this: maintain permanent dry powder combined with systematic value buying during crashes. Let me break that down because I know some of you are already thinking, that's just keeping cash and buying the dip. Wrong. That's not what I'm talking about. What most people call dry powder is emergency savings or money they're temporarily keeping in cash until they find something they like. That's not a strategy. That's just being unprepared with a fancy name. Real dry powder is a permanent allocation. It's 20 to 30% of your investable assets that you keep liquid at all times, regardless of market conditions. Not 5%, not 10%, 20 to 30% minimum. Poor people hear that and panic. They say, "But Kevin, I'm losing out on gains by keeping that much cash." You're thinking short term. You're thinking like someone who's never lived through a real crash. Rich people think long term. They understand that the ability to buy quality assets at 50 or 60 cents on the dollar during a crash will make them far more money than chasing an extra 2 or 3% annually in a bull market. That's the discipline that separates wealthy people from everyone else. Here's what happens in every single market crash. Prices fall 20, 30, 40, sometimes 50%. Quality companies that were trading at 30 times earnings suddenly trade at 15 times earnings. REITs that were yielding 3% suddenly yield 7%. Bonds that seemed fairly priced become genuinely attractive. Everything goes on sale. It's the biggest wealth transfer opportunity you'll ever see. And 95% of investors can't take advantage of it because they're fully invested. They don't have dry powder. They're watching the sale happen, knowing they should buy, but they can't because all their money is already in the market and it's down 30%. Even worse, many of them are forced to sell at the worst possible time. They need cash for an emergency, or they panic and want to cut their losses, or they get a margin call. They're selling assets at the absolute bottom to raise money. That's financial suicide. That's what poor people do. Rich people are doing the opposite. They're buying when everyone else is selling. They're deploying that 20 to 30% dry powder into quality assets at massive discounts. And when the market recovers, which it always does, their returns are absolutely extraordinary. Let me give you specific numbers so you understand the magnitude of this. In March 2020, the S&P 500 dropped 34% in about 5 weeks. Quality dividend stocks like Johnson & Johnson fell from $150 to $120. Microsoft dropped from $170 to $135. Visa went from $210 to $155. Coca-Cola fell from $60 to $42. These are world-class companies that suddenly went on sale. If you had dry powder and bought during that crash, you doubled your money in less than 18 months. Doubled it. Not over 20 years. 18 months. In 2008, during the financial crisis, the drops were even bigger. The market fell 57% from peak to trough. Companies like Apple, which is now the most valuable company in the world, traded under $85 per share, adjusted for splits. Amazon was under $40. Google was under $350. Goldman Sachs fell to $52 from $237. If you bought quality companies during that crash with dry powder, you made 10 times, 20 times, in some cases 50 times your money over the next decade. That's generational wealth. That's life-changing money. But you can only access those returns if you have cash when everyone else is panicking. Now here's where the strategy gets even more powerful. It's not just about having dry powder, it's about how you deploy it. Most people who keep some cash on hand blow it all in the first 10 or 15% drop. They think they're buying the dip, but the dip keeps dipping. They run out of ammunition halfway through the crash, and then they watch helplessly as prices fall another 20 or 30% to true bargain levels. They bought too early with too much. That's almost as bad as not having dry powder at all. The wealthy don't make that mistake. They use systematic deployment. They buy in tranches. If they have $300,000 in dry powder, they might deploy $50,000 at a 10% drop, another $75,000 at a 20% drop, another $75,000 at a 30% drop, and hold the rest for a 40% plus drop if it happens. They scale in systematically. They're not trying to time the exact bottom because nobody can time the exact bottom. They're buying quality assets at progressively better prices as the crash unfolds. This is what separates winners from losers in investing. Poor people try to time the market perfectly and end up doing nothing. Rich people accept that they can't time it perfectly, so they build a system that profits regardless of whether they catch the exact bottom. They know that buying great companies at a 30% discount is fantastic. Buying them at a 40% discount is even better. And buying them at a 50% discount is generational opportunity. They win at all three levels because they have the dry powder and discipline to execute. Let me tell you what happened to people who didn't have this strategy in 2008. I saw it firsthand. Investors with portfolios worth $2 million watched them drop to $1 million. Some dropped to $700,000. They needed money for expenses or got scared and sold at the bottom, locking in catastrophic losses. Meanwhile, investors who kept 30% in cash, $600,000 if we're using the same $2 million starting point, saw their invested portion drop from $1.4 million to maybe $700,000. Yes, they took a hit, but they had $600,000 in dry powder. They deployed it systematically at 20, 30, 40, 50% drops. By 2010, they weren't just back to even, they were ahead, way ahead. And by 2015, they doubled their original wealth, while the people who sold at the bottom were still trying to recover. That's not luck. That's not market timing. That's having a strategy that works in all market conditions. It underperforms slightly in raging bull markets because you're keeping 20 to 30% in cash, earning basically nothing. But it absolutely crushes the market over full cycles that include crashes. And here's what most people don't understand. Crashes are part of the cycle. They're not anomalies. They're not black swan events. They happen regularly. We've had major corrections or crashes in 2000, 2008, 2020, and we'll have another one. Maybe in 2026, maybe 2027, maybe tomorrow. It's coming. If this makes sense to you, if you're starting to realize that maybe keeping 95 or 100% of your money invested at all times isn't the brilliant strategy you thought it was, then do me a favor. Leave a comment right now telling me what percentage you currently keep in dry powder. Be honest. Most of you are going to say 0 or maybe 5%. That's fine. At least you're being honest. Now you know you need to change that. The second component of this strategy is knowing what to buy when you deploy your dry powder. This is where most people screw up even if they have cash available. They panic buy whatever's dropped the most, thinking the biggest losers will have the biggest bounce. Wrong. Dead wrong. That's how you end up buying garbage companies that fell 80% and then go bankrupt. You need to buy quality. You need to buy companies with strong balance sheets, low debt, competitive advantages, and products or services that people need regardless of economic conditions. I'm talking about companies like Procter & Gamble. People don't stop buying toothpaste and toilet paper in a recession. Johnson & Johnson. People don't stop needing medicine and healthcare. Waste management. Trash doesn't stop piling up when the market crashes. Costco. People still need groceries. Walmart. People still shop for essentials. These are boring companies. Poor people ignore them in bull markets because they're not sexy. They don't triple in 6 months. They don't have exciting stories. They don't get hyped on social media. Rich people love them in crashes because they're predictable, stable, and they go on sale just like everything else. When Procter & Gamble falls from $140 to $110 in a crash, that's a gift. The company isn't going bankrupt. It's not struggling. Revenue isn't collapsing. The market is just selling everything indiscriminately. You're getting a world-class business at a 20% discount for no reason other than fear. That's when you deploy dry powder. You buy quality at bargain prices. Then you hold it while the market recovers and watch your returns compound for years. The same applies to REITs if you're income-focused. During crashes, quality REITs get hammered along with everything else. A REIT that was yielding 4% might suddenly yield 7 or 8% because the price dropped 40%, but the dividends stayed stable. If you buy it with dry powder during the crash, you're locking in that 7 or 8% yield potentially for decades. Plus, you get price appreciation when the market recovers. That's a double win. That's how rich people build income streams that fund their lifestyle forever. But here's the critical part. You have to have the dry powder before the crash. You can't build this strategy after the crash starts. By the time the market's down 20% and you realize you need cash, it's too late. Selling assets that are down 20% to raise cash defeats the entire purpose. You're locking in losses to create buying power. That's backwards. That's financial suicide. The dry powder has to already be there, sitting in high-yield savings or money market funds, waiting patiently for opportunity. I moved 30% of my investable assets to dry powder years ago, and I've maintained that allocation regardless of what the market's doing. When people tell me I'm missing out on gains, I smile. I know something they don't. I know that the next crash will hand me opportunities they can't access. I know that my long-term returns will crush theirs because I'll buy quality at 50 cents on the dollar while they're paralyzed with fear and broke. That's not arrogance. That's 40 years of experience watching the same patterns repeat over and over. Here's the brutal truth. Most people won't implement this strategy. They'll read this, nod along, say it makes sense, and then do nothing. They'll keep 100% of their money invested because they're afraid of missing out. They'll convince themselves the market won't crash, or that they'll move to cash when they see warning signs, or that they'll be fine because they're diversified. And when the crash comes, they'll get slaughtered. They'll watch their net worth evaporate. They'll panic and sell at the bottom or hold on while their portfolio bleeds out. And they'll learn the most expensive lesson in investing. Hope is not a strategy. Rich people don't hope. They prepare. They keep dry powder. They buy systematically when others panic. They build wealth during crashes, not despite them. That's the only investment strategy that survives market crashes every single time. It's simple, it's proven, it's boring, and it works. The question is whether you have the discipline to implement it and the patience to maintain it while everyone else is chasing the next hot stock in a bull market. That's what separates you from them. That's what determines whether you build lasting wealth or spend your life recovering from financial disasters. Let me tell you about another aspect of this strategy that most investors completely miss. It's not just about what you buy during crashes, it's also about what you avoid. During market panics, certain sectors get obliterated more than others. Highly leveraged companies get crushed. Speculative growth stocks that were trading at 100 times earnings fall 70, 80, 90%. Banks with questionable balance sheets collapse entirely. Real estate developers with too much debt go bankrupt. You see these assets trading at what looks like ridiculous discounts and you think you're getting a deal. You're not. You're catching a falling knife. You're buying garbage at garbage prices. Just because something fell 80% doesn't mean it can't fall another 50% from there. Just because a stock went from $100 to $20 doesn't make it cheap. It might be going to zero. Poor people see big percentage drops and assume that means opportunity. Rich people understand that quality matters more than price. They'd rather buy a great company down 30% than a terrible company down 70%. This is where your pre-crash preparation becomes absolutely critical. You need to identify quality before the crash happens. You need to know which companies have fortress balance sheets, which ones have sustainable competitive advantages, which ones generate consistent cash flow regardless of economic conditions. When the crash comes, you stick to your list. You don't get distracted by the bigger drops in speculative garbage. You buy quality at reasonable discounts, and you sleep well at night knowing those companies will survive and thrive. I've seen people destroy their wealth by trying to be heroes during crashes. They think they're smarter than everyone else. They buy failed banks, collapsing retailers, over-leveraged real estate companies. They convince themselves they're getting generational deals. Then those companies go bankrupt or stay depressed for years while quality companies recover and soar. That's the difference between smart opportunism and reckless gambling. Smart opportunism is buying Johnson & Johnson at $120 when it was $150. Reckless gambling is buying a regional bank at $5 that was $30, hoping for a government bailout. Now here's what you need to do immediately. First, calculate your current dry powder percentage. Take your total investable assets and figure out what percentage is liquid: cash, money market funds, short-term treasuries. If it's under 20%, you're not prepared. Start building it now, not next month. Not after the next rally, now. Every week or month, take a portion of your income or sell a portion of overvalued positions and move it to dry powder until you hit 20 to 30%. Second, create your deployment plan. Decide right now what you'll buy and when. At what price will you start deploying? At what intervals will you add more? You need this written down before the crash happens, because during a crash, you won't be thinking clearly. You'll be emotional. You'll be scared. You'll second guess yourself. Having a pre-written plan removes emotion from the equation. You're just executing what you already decided when you were calm and rational. Third, identify your quality targets. Make a list of 10 to 20 companies or funds you'd love to own at the right price. Focus on low debt, high quality, essential businesses, companies with pricing power, companies with strong management, companies that have survived previous crashes and come out stronger. When the crash comes and these companies fall 20, 30, 40%, you'll know exactly what to buy. You won't be scrambling to research companies while the market's imploding. You'll be ready. Fourth, set up your dry powder account properly. Don't just leave cash sitting in a checking account earning 0%. Put it in a high-yield savings account or money market fund earning 4 or 5%. That's not going to make you rich, but it's better than nothing. And when the crash comes, that money is still liquid and ready to deploy within 24 hours. You're not sacrificing accessibility for yield. You're getting both. And finally, commit to this strategy for the long term. Don't abandon it after 6 months because the market rallied and you feel like you missed out. Don't abandon it after 2 years because your friends are bragging about their gains and making you feel stupid for keeping cash. Crashes don't run on your schedule. The next one might be next year, it might be in 3 years, it might be in 5 years, but it's coming. And when it arrives, you'll be the one with dry powder while everyone else is bleeding. You'll be building wealth while they're desperately trying to survive. That's the power of preparation. That's the only investment strategy that survives market crashes. Smash that like button right now if this is making sense. Share this with someone who needs to hear it, a friend, a family member, someone who's fully invested and vulnerable to the next crash. They might not thank you now, but they'll thank you when they're buying quality assets at 50% discounts while everyone else is panicking. Hit that like button, share this video, and become part of a community that understands real wealth isn't built by chasing bull markets. It's built by surviving bear markets. But don't stop there. Become a member of this channel. When you become a member, you're investing in your financial education. You're joining a community of people who are serious about building lasting wealth using proven strategies, not gambling on hype and hope. You'll get access to deeper analysis, specific recommendations, and ongoing guidance as markets evolve. Subscribe, become a member, and let's build the kind of wealth that survives crashes, recessions, and every other financial disaster the market throws at us. This is how you win. This is the only way. Let's get to work.